Ever see someone on YouTube or TikTok saying they turned $10,000 into a million investing in some next-gen tech stock or crypto project? Yeah, we've all seen that movie. And it usually ends with a line like, if you just invest $100 in Bitcoin back in 2011, as if we all had a time machine and nerves of steel. But compounding doesn't work like that in real life. It rewards consistency, not the impulsive. And today we're going to talk about what happens when chasing high return becomes a trap, and how to still aim high without losing your financial sanity. I am the financial watchman, helping you guard your dollars and your mindset so you can grow wealth the smart way. Let's get into the video. Now here's where most investors mess up. They learn about compound interest, get hooked, and then think, if 10% a year can make me rich, imagine what 50% could do. So they start jumping from stock to stock, chasing the next Tesla, Nvidia, or Shiba Inu, the typical story. And then what starts as disciplined investing becomes a game of financial hopscotch. But compounding doesn't like chaos. It needs time and consistency. Every time you panic sell, overtrade, or jump to a hot pick, you reset the clock. And remember, every crash, correction, or bad year makes you question your choices. If you can't handle 30 to 50% drop, you're not investing, you're gambling with emotions. Let's talk about the myth of infinite returns. There's this illusion floating around the internet that 30% plus returns are normal if you're smart enough. Reality check. Even professional fund managers struggle to beat the S&P 500's 10% long-term average. So if someone's promising 100% annual growth, they're probably not compounding wealth, they're compounding risk. A consistent 8 to 10% annual returns held over 30 years turns ordinary income into generational wealth. Meanwhile, the guy chasing 50% returns often ends up with 50% losses and a new excuse every year. But what about 10x and 20x stocks? Alright, let's get real. Yes, some companies do 10x or even 20x. Think about Apple, Amazon, Tesla, or Nvidia. Early believers saw their investments multiply beyond imagination. But here's what most people forget. Those investors didn't ride a smooth escalator. They survived a roller coaster. Listen, Amazon dropped over 90% after the dot-com crash. Tesla had multiple 50% drawdowns before it became the powerhouse it is today. And with the unpredictability of their CEO, Elon Musk, you could pretty much predict a bumpy ride in the future while looking for growth. Even the golden child, Apple, had years of dead money before the iPhone changed everything. So listen, these weren't quick flips. They were decade-long commitments built on research and conviction. So yes, you can aim for those 10x returns, but only if you understand what it truly takes to hold through the fire. When you invest in a company with explosive potential, you have to treat it like owning a small piece of a business, not a lottery ticket. It means understanding the company's fundamentals. What problem are they solving? How are they earning revenue? Who's their competition? What's their debt like? Because when the market tanks, and it will, only research and conviction will stop you from panic selling at the bottom. The people who made life-changing returns on Tesla, Nvidia, or Apple didn't just get lucky. They did their homework, invested with patience, and ignored the noise. And see, that's the key difference between chasing high returns and earning high returns. Let's talk about strategy versus speculation. Speculation buys because it's trending. Strategy buys because the business has long-term potential. Speculation sells at the first dip. Strategy holds through volatility with conviction. Speculation follows social media hype. Strategy follows a personal investment thesis. Speculation treats investing like gambling. Strategy treats it like ownership. You can invest in riskier, high potential companies, but do it intentionally as a part of a balanced portfolio. Maybe 80 to 90% of your money sits in broad, steady index funds or solid dividend companies, while 10 to 20% is your conviction capital. That way, even if your moonshot investments crash, your long-term wealth does not. Let's get into the patience tax. The hardest thing about conviction investing isn't finding the next big stock, it's holding it through the pain. If you'd invested $10,000 in Amazon in 1999, it would have fallen to $1,000 by 2001, and most people would have quit right there. In fact, most people did quit. But if you held it for the next 2 decades, that same $10,000 would be worth millions. That's not luck. That's emotional endurance. It's called paying the patience tax. You earn your reward not by timing the market, but by surviving its corrections. Do you know when to avoid the trap? When people hear high return, they forget about high risk. There's nothing wrong with believing in great companies, but there's everything wrong with overexposing yourself to one. Even great companies can fall hard. Remember Enron? Remember Kodak? Remember Blockbuster? Conviction investing without diversification is just blind faith in disguise. So if you're going after the next 10x stock, set boundaries. Know how much of your portfolio you're risking. Revisit your thesis yearly. And most importantly, don't invest money you'll need in the next 5 years. Don't do it. Now, regarding the balanced approach, here's the formula that works for most long-term investors. Build a strong base of diversified investments, such as index funds, ETFs, and blue chips. Add a layer of conviction, companies you've studied, believe in, and can hold long-term. Stay patient. Time and consistency are what turn $10,000 into $1 million, not guessing which stock will moon next. That's how you win both ways. You let compound interest do its job and give yourself a shot at greatness. Because let's be honest, sometimes the next Amazon, it's out there, but only those who combine discipline with belief actually benefit from it. Conclusively, compounding isn't just numbers, it's about behavior. It rewards patience, punishes panic, and ignores hype. So yes, invest in great companies. Dream big, but don't let greed make your decisions. Remember, bulls make money, bears make money, pigs get slaughtered. Because when you chase the fast compounding, you often end up compounding your mistakes. I am the financial watchman, helping you keep guard over your dollars so you can learn to guard them yourself. This video is for educational and motivational purposes only and should not be taken as financial advice. Always do your own research or consult a licensed financial professional before making investment decisions. If you would like to support the channel, please review the link in the description. buymeacoffee.com/The Financial Watchman. And I'm signing out. Bye bye, y'all.